If you could have $100 right now or $150 in 1 year, which would you choose and why? So this is an interesting question. I think it's pretty simple on the surface to say that you choose $150 in 1 year, and I think that that is true for most people most of the time. The problem comes when you are how are you going to get to that $150, right? If you're somebody who is living paycheck to paycheck and you're broke, you might choose $100 right now because you need that money. And so that's going to be the whole thing with investing. The whole thing with investing is going to be how good are you going to be at living below your means now so that you can save money to invest? How likely are you going to be in that position where you're going to be stuck taking the $100 right now because you absolutely need it? That's the importance of creating a budget, and that's why we've learned all the things we've learned up until this point, so that we have extra money to invest. Now, this is sort of a ridiculous question, admittedly, because well, what item are you going to have a 50% return on in 1 year? And what item are you going to have a guaranteed return at the same time? Usually we're talking about 10% return in the stock market. We're talking about likely that it's going to return some, but not necessarily guaranteed. So you have to sort of figure out how that looks for you. But in this case, the principle is sort of still the same. If you choose $100 right now or $150 in 1 year, it's sort of like the marshmallow test that we watched a video on earlier in the year about denying yourself now having delayed gratification, because sometimes if you can wait, you can end up in a better position in the long run. But it takes the discipline to be able to wait. So, can you think of any money management strategies that involve waiting to spend money in order to grow the initial amount? Answer that question in your notes. So, both savings and investing can earn money because of potential benefits such as interest and rate of return. So, rate of return is the amount gained or lost on an investment over time, expressed as a percentage of the initial amount invested or the principal. So if you're going to answer in your notes the definition for rate of return, it's just going to be the first half of that, the amount gained or lost on an investment over time, and principal is the initial amount invested. So what's going to happen is, let's say that you have $1,000 to invest, and you put that $1,000 into some sort of market. Maybe we put it into a stock, and after a year, that $1,000 is $1,100. Well, you have a 10% rate of return based on what the original was, and that principal was $1,000 because you grew it by 10%. So that's what's the rate of return. If you're talking about interest, you're talking about a rate of return of maybe 0.1%, anywhere up to 2 or 3%. If you're talking about investments, you're talking about maybe more, but there's a rate of return on all kinds of different things that you could be putting your money in. If you are just keeping money as cash or just keeping money in a checking account, you do have a rate of return. That's actually going to be a negative rate of return because the money stays the same, but the buying power disappears because of inflation. So we'll talk more about inflation, I think, in a couple weeks. So that's something to keep in mind as well. So here are a few investment strategies that involve waiting on spending your money. One is a bond. A bond we've talked about before, we'll talk about it again, is a type of loan in which you are the lender and the government is the borrower. It's usually pretty stable and usually pretty secure. In fact, it's stable and secure as long as the U.S. is paying on their debt obligations. So as long as the U.S. continues to be able to do that. Next is a mutual fund. A mutual fund is a mixture of bonds and stocks that is managed by a professional. Mutual funds are safer than stocks, but not as safe as bonds, but have a much higher rate of return than bonds and a much lower rate of return than stocks. And that's a way that you can grow your money, but in a diversified way. And then stocks are when you buy a share of ownership in a company Some stocks are really risky, like if you were to buy stocks in any kind of cryptocurrency, like Coinbase or something like that. Stocks can be very risky if you're buying startups, tech companies, things like that. Or stocks can be very safe if you're buying stocks like Amazon or Apple or Google or Home Depot or Ford or any of the companies that you purchase. And we'll talk more about stocks later on in this week, Thursday and Friday this week. But stocks are buying a portion of the company. So these are three strategies that you can actually grow your money if you're willing to put it away for a while. If you've got 5, 10, 15 years to wait on this money, you could double, even triple that money sometimes. Even quadruple that money. If you can keep it in there for 15 years on average in the stock market or in a mutual fund, you'd likely be able to quadruple your money in certain cases. But the problem is that you have to be able to keep it there. So when determining how to manage your money, it's important to consider the risks and rewards involved. So back on this graph right here, bonds have lower rewards and also have lower risks. Stocks have high reward, but also high risk. Mutual funds are a middle combination of the two. For example, savings options such as certificates of deposit offer guaranteed interest rates, making them low risk, but it can often take a long time for money to grow because interest rates are lower. They also have very low reward. If there was an option for low risk, high reward, that's where everybody would put their money. The problem is that with greater potential reward always comes greater potential risk or greater potential effort. I think that maybe real estate might be the kind of thing where you could invest and have lower risk with higher potential reward, but real estate is a lot of effort involved, where buying things like stocks or bonds, that money just sits there and it works on its own. You don't have to actually be managing it the way you would with real estate. So investing options offer higher rates of return than something like CD, but they can be variable, meaning they change over time and can be more of a risk. You never know when supply chains are going to be interrupted by a global pandemic. You just never know. You never know. You've got all your money in Southwest Airlines and people stop wanting to fly because there's a pandemic. So you just never know what's going to happen. You never know whether the CEO of your company is going to have some scandal that shakes up the company. You never know when a new competitor is going to come into the space and do things better. Even some of the blue blood stocks from 20 years ago, think things like Blockbuster, didn't change with the times. So do you think Amazon's going to change with the times? Probably, but it's not necessarily guaranteed. So you have to think about these things. You have to realize that with greater risk comes greater potential reward, but also with greater potential reward comes greater risk. So here's this video. In your notes, there are 4 questions. Here's what the questions are. You can answer these questions while the video is playing. I have also given you the video in your notes. Actually, why don't you just watch the video in your notes? You've got that link right there. Go ahead and click on that link and watch that video. And then answer these 3 questions. Depending on the investment choices you make, the end results can vary drastically. By making wise investment choices and starting at a young age, we can maximize long-term savings and increase wealth over time like Damon. But it's also possible to lose some or all of the money you've invested. For example, the average annual rate of return on the stock market since 1926 is close to 10%. That means if you put $1,000 into the stock market, by the end of the year, you would have $1,100. And then the next year, your principal would become $1,100, and you would have 10% on that, and it grows and grows and grows. However, in 2009, when our country was experiencing a recession, stocks lost 37% of their overall value. Similar thing happened this year. Last year, 2020, stock market crashed. So it is likely going to go up, but it's not necessarily guaranteed. And if you put the money in there at the wrong time, you have that risk. I say that if you're putting money into the stock market, I would be willing to leave it alone for 5+ years. Okay. And that's in index funds, mutual funds, all kinds of different funds. If you put your money in the stock market, be willing to leave it alone for 5 or more years, because you just never know. You put the money in there and then it takes that dip. After 5 years, it's likely to be up, but I can't guarantee that it's going to be up after 1 year. I can't even guarantee it's likely to be up after 5 years, or that it's going to be up after 5 years, but it's likely to be based on the history of the market. Depending on your stage in life, there are different levels of risk to assess. For example, if you're about to retire making risky investments, would it be wise because you need cash flow to live on while in retirement? A good example of this is my parents have they're looking at retirement in the next few years, and they have in their portfolio, they have a lot more bonds. Bonds are much safer. I, on the other hand, am not looking to retire for multiple decades, and so I have a lot more stocks, and that's because I can handle more risk with my investments because I don't need that money right away. If the stock market goes down, I can be comfortable that it's going to grow in the long run. Okay, so that's how that might change. There are some plans, some 401k plans that automatically change for you when you hit certain ages and certain benchmarks. It shifts away from stocks and towards bonds gradually, based on what your age is and what your target retirement date is. What do you think you could have in your portfolio when you're close to retirement to minimize risk? So I sort of just gave that answer. I would say bonds, but you could have other things. You could have real estate. You could have all kinds of different things. In the opposite vein, Damon is so young, he's able to take on more risk in his investments because he has time to recap any potential losses. So that was a sort of an introduction to investing. You've got your Smart About Money investing. That should give you a bunch more sort of thoughts and things to consider when it comes to investing. The key to investing is to understand what you're putting your money in, and if you have an investment advisor, to have that person tell you and explain to you what you're putting your money in, and to be able to live below your means so that your money can make money for you. There's a saying, I think it's right, that poor people work for their money and rich people have their money work for them. Now, it's harder to get there if you're not already there, if you don't have that extra money, but you can live below your means so that you can have extra money to start working for you. So that's the lesson for today.